Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we are going over 5 undervalued dividend stocks. As you can see, this is my portfolio right now. It's about 14% or 14.5% up for the year. Stocks are going up every single week. It seems that they keep going up. I'm not complaining, but I'm just wondering how long this will continue. Maybe another year, maybe in a couple of months, maybe weeks. Whatever the situation is, I will always be buying stocks, inshallah. Every single week, my plan is to add as much as I can and keep buying. By the end of the basically March, I would like to max out my basically ISA account, and that's my target. So I still have £3,600 to add to this portfolio, and inshallah, that's what I intend to do, and I'm going to keep doing that. So what I would like to do now is to go over some of the companies, but before we do that, I just want to quickly show you companies that are reporting next week. So there's not a lot of none of the companies that I do have in my portfolio actually are reporting, but the ones that I'm really interested is Salesforce. I will be interested to see what they report, number one, and to see what they say about AI and so on. Canadian Natural Resources is another one that I would be keeping an eye on, or keep SNQ. So yeah, there's a couple of other companies that are reporting. And finally, of course, as always, we need to look at the fear and greed situation. And right now, as you can see, we're now on 78. So we extreme greed right now. And it's really happening because there have been some of my mates that have not spoken about anything to do with the stock market for a long time, and right now talking about, you know, the supercomputer, super microcomputers and NVIDIAs and the AI and everything else, you know, all the hypes. And you know, again, we're talking about Bitcoin, and the whole crypto situation is happening again. So yeah, of course, there's a lot of these things happening around us. So, but as always, like I have done over the last 3 years, I'm going to continue buying what I believe are high quality businesses and keep holding on to it until, inshallah, one day thesis change or something happens. I want to take some profit off the table, whatever the situation is. That's my plan, and that's what I'm going to do, continue basically going forward, inshallah. And before we look at the 5 companies we're going to talk about today, I would really appreciate if you can join us on the Patreon account, where you get access to all the dividend trackers that we use, as well as, of course, the Discord, where you meet brothers who are actively sharing good practices. Right, let's get started. Like I said, these are 5 dividend paying companies that are undervalued at the moment according to Morningstar valuations. Okay, so they use their own, and one thing I like about Morningstar is since I started using them, they've always I'd like to think they have some sort of embedded margin of safety, because a lot of the companies that they suggest and a lot of the prices that they suggest is normally reasonable, and these companies have done well over those period of time that I was holding these stocks. So I like that, but at the same time, I always add at least a 5%, 10%, if not more, of margin of safety for myself. So if you want to, do that, that's absolutely fine. Let's have a look at the first company. And that company is EOG Resources. This is one of the oil companies, energy companies, 64.9 billion market cap. It has a narrow economic mode. Right now it's trading $111 per share. It has a nice dividend of 3.25, and the payout ratio right now is 29%, which is very, very low. The reason we're after lower payout ratio is because then it gives the company the opportunity to increase that dividend. So that means they're not spending 98, basically 100% of their net income paying as dividends, and for that reason they will not be able to increase and so on. So lower payout ratios are always good. Latest increase was 10%, which is quite nice, and the 5-year basically dividend growth rate is 33%, which is quite huge. But they've only been increasing that dividend for 6 years, so it's quite really recent, but that is really nice. So for the last 6 years, they've actually increased it for 33%, which is very, very nice. The annual payout is $3.64, and safety is 82%. Now, so according to Simply Safe Dividend, 61% and above is safe, and then very safe, and then so on. So 99 is the highest any company can have. In terms of profit margin is 32%, return on equity of 28%, and return on invested capital of 25%. They have $5 billion of free cash flow right now, and the total return in the last 10 years is 4%. Growth estimate for the next year is 4%. But what the analysts are saying right now is after that, the company, basically the earnings will decline about 1% every single year for the following 5 years. That could easily happen, okay? And I don't know if you remember, if you've been with me for quite some time, you will remember some of the semiconductor companies in 2022 were actually similar sort of situations where they were saying for the next 3-4 years, these companies will decline 3%, 4%, 5%, more bigger than that. And even Qualcomm had a negative at some point growth estimate for the following 5 years. But very quickly, these things have changed. So very cyclical businesses tend to have those kind of predictions because no one knows what's going to happen. So the oil prices could basically go up to the roof again. And then what happens? These companies start making more money. The growth estimates is basically for the company changed. So you have to take that into consideration when you're buying these companies, and don't just think about, okay, what's going to happen next year. If you are, a long-term investor and you're thinking about for the next 5 years, that's probably one thing you should do. Right, moving on. And then Morningstar valuation right now is saying about 13% discounted. Right now, $129 per share is where they think the price should be. The next company we're looking at is one that is in the semiconductor company. This is the main company when it comes to the actually producing those chips that go into every single thing that we own. So TSM creates basically the devices, basically the equipment that's used, and the Taiwan Semis actually creates it. And company like Nvidia will design what they want. They will give it to Taiwan Semi, and then Taiwan Semi will actually make the product itself. Okay, so right now it's trading 572 billion market cap. It has a wide economic moat, and the current price is $129 per share. So it has gone up quite a bit recently, but it still seems basically discounted. So dividend yield of 1.7. and payout ratio only 37%. Latest increase was 17%, and 5-year growth rate of 10%. They've only increased that dividend for 1 year. $2.29 is what you will get for every share of this company that you own. And safety right now is 62%. Profit margin 28%, return on equity 25%, return on invested capital of 21%. And they do have over $16 billion of free cash flow right now. Total return in the last 10 years is 23%. And they're expecting the earnings to grow the same number next year, so 23%. And then after that, about 4%. It's 14% discounted right now, and $151 per share is where the price should be. Now, I really like this company, but the issue is we cannot buy this company within the ISA account. So if you have a normal investor account, general investment accounts, then you could potentially add to your portfolio. But again, of course, do your own research and so on. Next one is the only company that I own on this list, and that's Medtronic. This is a company that basically produces basic equipment that is used in hospitals. It currently has 114 billion market cap, wide economic moat. Price is right now $85 per share. So it has gone up quite a bit. It was trading about 80, 79, 70 something to all the way to 80s, and then it has come up a little bit in the last few weeks. Dividend yield, we're looking at about $3.22. Payout ratio of only 52%, and latest increase was 1.5%. Now, that is not a lot, but because of what the company has been going through lately, it's actually fine. So they keep trying to keep that, the dividend aristocrat status. But the 5-year growth rate is 8%, which is quite nice. So annual payout, you get $2.76. Safety is 99%, so no issues with that. Any dividend cuts anytime soon. Profit margin 13%, return on equity 8%. And return on invested capital of 8% as well, which is quite nice. Free cash flow almost $5 billion. Total return in the last 10 years 6%. Growth estimate expectation for next year is 5%, then 3% after that for every year. 24% discounted. Right now $112 per share is where the price they think the price should be, but right now we're looking at $121 per share. $85 per share. Right, so the next company we're looking at is Kimberly-Clark. This is one of the companies basically very similar to Procter & Gamble. There's consumer staples. They sell all sorts of nappies and, tissue and all of that stuff. 41 billion market cap, narrow economic moat, $121 per share right now. Dividend yield above 4%, which is quite nice for the first time. I have not seen this company trade that much lately. Payout ratio 72%, so very high, okay, but not too bad. I think if the plan, hopefully in the next few months, if it comes down on next couple of quarters, that would be okay. Latest increase was 3% and the 5-year growth rate of 3%. They are a dividend king because they have increased that dividend for 51 years. $4.88 is what you will get for every share of this company that you own. 88% safety. Profit margin, we're looking about over 8%. Return on equity, 241%. And return on invested capital, very healthy, 29%. $2.7 billion of free cash flow. 4% total return in the last 10 years. Growth expectation is 6% next year, and then 5% after that. 12% discounted right now. $139 per share is where the price basically they think should be. Right now is $121. Now, this is one of the companies that I like to call, like it is a very stable company, as well as, of course, it has a very low beta. So it's one of those stocks that you own for the dividends and that, 4 to 7% growth every single year. And of course, you're not going to beat the market with that, but at the same time, it keeps your portfolio stable. So it's a kind of foundational stock, if you like. And finally, Skyworks Solutions, another company in the semiconductors, 16.6 billion market cap. It has a narrow economic moat, $103 per share, dividend of 2.62%, which is quite nice. Payout ratio only 33%, and latest increase was almost 10%. 5-year growth rate of 14%, which is very, very good. They haven't been increasing that dividend for the last 3 years, and $2.72 is what you will get for every share of this company that you own. 68% safety, so very safe. Profit margin 19%, return on equity 15%, and return on invested capital of 14%. $1.6 billion free cash flow right now. Total return in the last 10 years, we're looking at about 14%, which is very healthy. And guess what? Growth estimate for next year is 19%, then 15% every single year. So it's just absolutely huge. This is very interesting. I do remember where Qualcomm was around this situation where it was down for like basically 22% or so. And this company is almost in that situation right now. So 22% discounted right now, $133 per share is where they think. So that's about $30 from where we are right now, which is quite interesting. So that's the 5 companies that I want to share with you guys. I'm going to quickly show you the Sharia compliance side of things, so you can pause the video. But there's no issues. The only one I would be worried a little bit of is Space Medtronic, where it has a little bit of interest-bearing securities. Remember, we're looking about 33% and above. So right now it's about basically 27%. Nothing huge to worry about, but that's the only one I will be worried a little bit. But that's the 5 companies I wanted to share with you guys. They all seem undervalued based on Morningstar valuations. And of course, there is becoming very difficult to now find undervalued stocks. So I will do a couple of more videos like this, inshallah. If you're interested, let me know. If there are any companies that are on your watch list that you would like me to have a look at as well, please let me know in the next few days, inshallah. Work is getting crazy, so I'll see, inshallah, how next week goes. But as soon as I get a chance, inshallah, I'll maybe do one of those 10-minute videos for single stocks, inshallah. So if you have any suggestions, let me know. If not, I'll continue doing what I've been doing. Of course, as always, please like the videos. It makes a huge difference, as well as, of course, joining us in a Patreon account if you can, where you get access to the Discord, inshallah. Have a wonderful day. Assalamu Alaikum.